Welcome to Phillip Mastermind. I'm Kim. Sell in May and go away is a traditional investment saying that suggests investors should sell their stock holdings in May and reinvest in November based on the historical underperformance of the stock market during the summer months. When considering the Malaysian market, which is represented by the KLCI, historically, May has shown weakness for the KLCI with an average return of negative 1.35% over the past 10 years. In fact, in the last decade, only 3 years had positive returns. And if we extend the analysis to a 20-year time frame, KLCI registered a return of negative 0.68% over the past 20 years, and 8 of the past 20 years were positive in May. This may suggest possible profit-taking activities in the near term as investors brace the adage of sell in May and go away. On the other side of the globe, the US market, which is represented by the S&P 500 index, demonstrates a different trend. Over the past decade, it has seen positive returns in 9 out of 10 years, averaging positive 0.68% return. However, extending the analysis to a 20-year period, the average return in May drops to positive 0.19%, impacted by occasional negative returns in 2011, 2012, and 2013. Consequently, the MSCI World Index, which has a large weightage in the US market, exhibited a positive overall return in May over the past decade, positive 0.24%, and yet displayed a negative return over the past 20 years, negative 0.43%. If the sell in May and go away paradox proves true, exercising caution might be prudent, particularly when considering the Asia-Pacific ex-Japan market as represented by the MSCI Asia-Pacific ex-Japan Index. In this market, May has experienced a negative 1.05% return over the past decade. Positive returns were observed in only 3 out of 10 years. Separately, the Asia ex-Japan market saw a negative 1.61% return over the past 20 years, and positive returns were observed in 6 of 20 years. These can be attributed to the weakness in the Hong Kong market, averaging negative 1.79% over the past 10 years, while positive returns were observed in only 4 out of 10 years. And Hong Kong market saw an average return of negative 1.33% in the past 20 years, and positive returns were observed in 7 out of the past 20 years. While historical patterns may suggest potential market weakness, it is essential to remember that past performance does not guarantee future returns. We believe investors should stay invested for the long term and ignore the short-term volatilities for the reason below. Number 1. Long-term prospect. Investing is typically a long-term journey. While short-term market fluctuations may cause concerns, the long-term trend of the market has historically been upward. By staying invested, investors can benefit from the compounding effect over time. Number 2. Timing the market is difficult. Attempting to time the market by selling when it's weak and buying when it's strong is very challenging. Exiting the market in May and re-entering in November based solely on historical trends may lead to missed opportunities if the market performs differently than expected. Number 3. Diversification. A well-diversified portfolio can help mitigate the impact of market weakness in specific sectors or asset classes. A skilled fund manager might opt to increase cash holdings, reduce equity exposure, or switch towards stocks with potential upside during the periods of market weakness, so the overall fund performance could be better when the market rebounds. Selling off investments entirely in May may disrupt this diversification strategy. Number 4. Opportunity costs. While saying sell in May and go away suggests exiting the market during historical weak periods, it also implies being out of the market during potential periods of growth. By staying invested, investors have the opportunity to capture gains if the market performs better than expected during the summer months. And ultimately, the decision to stay invested or sell during the market weakness depend on individual circumstances, risk tolerance, and investment objectives. It's essential for investors to conduct thorough research, maintain a diversified portfolio, and consider seeking advice from professional asset managers to make informed decisions. So, where are the pockets of investment opportunities? Well, we think Asia equities are attractive in terms of valuation and earnings prospect. According to IMF, the world economy is expected to grow at 3.2% during 2024 and 2025, at the same pace as in 2023. Advanced economies are expected to grow 1.7% in 2024 and 1.8% in 2025. But the emerging market and developing economies are expected to grow 4.2% in both 2024 and 2025. Specifically, emerging Asia economies are expected to grow 5.2% this year and 4.9% next year, driven by the growth in China and India. China is expected to grow 4.6% and 4.1% in 2024 and 2025 respectively, while India is expected to grow 6.8% and 6.5% in 2024 and 2025 respectively. After a prolonged stretch of lackluster performance in the Chinese and Hong Kong stock market spanning 3 to 4 years, there was a significant turnaround observed starting from February 2024. This reversal has resulted in a year-to-date gains of 5.1% for CSI 300 index and 4.2% for the Hang Seng index as of 30th April. And the rally has continued in early May, signaling a notable upward trend. Over the past year, the Chinese government has implemented a range of initiatives aimed at boosting confidence in the economy. During the Politburo meeting held on April 30th, China's top party leaders emphasized the importance of examining strategies to digest housing stockpile and control new supply. And fresh from the oven recently, Hangzhou is removing all restrictions on home purchase to revive the local housing market. Why is this important? Hangzhou is the capital of Eastern Zhejiang province and a major tech hub in China, and home to e-commerce leader Alibaba Group and car maker Geely. Following the lifting of home purchase restrictions, HPRs, in Hangzhou, only 7 core cities, Beijing, Shanghai, Guangzhou, Shenzhen, Tianjin, Xi'an, and Haikou, keep their HPRs so far. Although these cities aforementioned have relaxed their restrictions since last year, we believe more easing will come up and property sales is expected to recover month-on-month in May. Many investors are still focusing on property sector in China, but neglect its rapidly growing digital economy, including areas such as AI, EV, renewables, data mining, machine learning, cloud computing, and etc., which accounted for 41.5% of China GDP in 2022, according to the Chinese Academy of Information and Communications Technology. On a separate note, according to our channel checks, the contribution of the property sector to GDP has now declined to the mid-single digits. We believe the new growth areas aforementioned have the potential to expand further in China, transforming the economic structure over the long term. We also like domestic-oriented economies such as India, which will be supported by the rising consumption growth in the country. Indian economy is expected to exhibit strong economic growth with political continuity after the election. India has also surpassed China as the world's most populous country. Favorable demographics and investments into infrastructure will see India play to catch up. India is also 10 to 15 years behind China in terms of its economic development and is a circular growth story. We also like Taiwan and Korea as we anticipate a rebound in the tech cycle. Following a decline in 2023, we are seeing the beginning of an upturn in the global tech cycle, which should boost global trade. The WSTS is projecting a rebound in semiconductor sales at an annual growth rate of 11.8% in 2024 versus a decline of 10.3% for 2023. The tech sector accounts for the largest share of GDP in Taiwan, 19%, followed by Korea, 10%. The stocking pressures that waited on growth throughout most of 2023 are likely to ease in 2024. Finally, we also like Malaysia. We maintain a favorable outlook on Malaysian market for the medium to long term, and we expect that the 5 investment themes outlined here will continue to influence the future outlook of the Malaysian market. In terms of positioning, we think Johor, Sarawak, and Penang thematic play will continue to play out in 2024. The 3 states of Johor, Sarawak, and Penang contributed an estimated 26% to Malaysia's real GDP in 2022. We see excitement in the three states in 2024 driven by their catalytic developments and their longer-term growth plans, alongside recovery in tourism, which would benefit the country as a whole. In Phillip capital Malaysia, we have a wide range of private managed accounts, PGWA, and unit trust funds that could cater to different investors' needs. Whether you want to DIY, seek for advice, or let the expertise fully handle your portfolio, our platform, with a comprehensive list of products including discretionary private managed accounts and unit trust funds, can cater to your needs and preferred ways to achieve your financial goals. That's all for today. Stay tuned for our next Phillip Mastermind. This update is brought to you by Phillip Capital, your partner in finance.